Okay, good morning. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo.
It is 10:03 a.m. Pacific, May the 2nd, 2025, and what a start of a year it's been. Pretty interesting roundup in the markets. If you were a Rip van Winkle investor and you went to sleep in March 31st and just woke up today, what would you find? Well, you would find that the S&P 500 is up 1.5%. Pretty shockingly, you would find that the, Russell 1000 was up 1.7%. You would find even small caps, the Russell 2000 up 0.64%. You would find that technology stocks, the technology sector was up 5%. And so I think the point I'm trying to highlight there is, the markets endured massive tariff volatility this past month with Liberation Day coming April 2nd. Massive volatility ensued, and that volatility really shocked markets and led to price discovery and a huge spike in that changing asset prices. So just kind of digging more into on the week, it's been pretty a banner week for stocks. On the week, the S&P 500 is up 3%. The technology sector is up 4%, and the comm services sector is up 3.3%. So pretty strong performance there. The best performer, though, was industrials, having a little time in the limelight, up 4.7%. And the laggard this month was consumer staple. This week, was up 0.7%. And that was followed by utilities up 1.8%. But it's been a strong week. There's only one sector in the negative, and that's energy, which is down about 1%, which I think fell on the back of some OPEC Plus news on the idea that the Saudi Arabians are going to maintain production and that they're willing to endure lower oil prices in a market share play. So that's definitely something to keep an eye on. If you look at the crude oil markets, they're down on a week-to-date basis about 20%. As of the recording of this podcast, crude oil is down. It's trading around $58 a barrel. So definitely interesting week in equities where you had strength and you had a real reversal in the kind of tariff sell-offs over the past few weeks, leaving investors in the positive if they didn't make any knee-jerk reactions. And I'm gonna throw this out there. I mean, if you look in 2018, the average tariff rate was about 2%, and that sextupled to about 12% after Liberation Day. And who knows where it's going to end up because we're in this period of grand negotiation. But that's a far cry from the 1828 Tariff of Abominations, which brought tariffs to 57% in 1830. So I think that, the markets are kind of realizing that tariffs definitely are a tax and they're disruptive to supply chains, but there's also room for negotiation. As we've seen, there's been a lot of walkbacks, and I think the kind of stoic hands in the market have done well, and panic sellers have been punished. But I do think you have to stay apprised of the fact that investors around the world are probably going to be changing their portfolios, even if there is resolution in many of these trade disagreements, and you have to really think about that in your asset allocation. Now, looking at the fixed income land, what we see is this week, not much has really happened realistically. I mean, you've seen rates go up about 10 bips on the week across the curve. The 2-year up 9 bips, 5-year up 8 bips, 10-year up 9 bips, 30-year up 9 bips. So pretty much a parallel shift out there from the 2s to 30s. And that's led to a little bit of a sell-off in the Bloomberg aggregate is down about 40 basis points on the week. Government's down about 26 basis points. Mortgage-backed securities down about 44 bips. High yield bonds, though, below investment grade bonds up 40 bips, and bank loans up 72 basis points. So, um, definitely a little bit of a reversal. And it's somewhat interestingly, if you look, look over the month of April, fixed income was down about 0.5%. And that was mostly on the longer rates being up. If you look at the 30-year US Treasury, that was up 23 basis points from March 31st through the recording of this podcast. And that kind of interest rate risk led to a slight decline in the Bloomberg Ag of 0.5%. But you had a bright spot. You had high yield bonds up about 0.5% and bank loans up 1%. So you could earn that carry, but if you had interest rate risk, you definitely were punished for it slightly as rates increased very modestly there. Now, looking at the commodity complex, it was definitely a very bad period for commodities with all this disruption. From March through today, March 31st through today, the Bloomberg Commodity Index is down 4.5%, with precious metals being a bright spot, up 0.6%, and gold up 3%. Even though on the week gold is down about 2%, currently trading around $3,230 an ounce. So definitely a lot of volatility in commodities. The hardest hit sector in the month was energy, which we've talked about already, down 14%, industrial metals down 6%, with the economic bellwether, Dr. Copper, down about 8% from March 31st first through today, and down about 4.5% on the week. So definitely a volatile period, and I think that investors are a little bit they're a little bit shell shocked, and they're just trying to really assess how things are going to evolve going forward as this grand tariff negotiation carries on. And with that, we'll kind of kick it off to the macro for the week, Kimmel, unless you have any opinions on the verdict of the market.
Yeah, I think you covered it pretty well. It's just rather remarkable how well risk assets have held up, just given the magnitude of the tariffs that have been brought forward. Just looking at where we started on the VIX heading into April, we're currently like right there. So just a complete rise and unwind of that rise in volatility. The bout of volatility in early April was just a bad dream, I guess.
Definitely a definitely a bad dream for Rip Van Winkle, and he's wakes up today and things are all right. But yeah, let's jump into the macro data for the week.
Yeah, let's do it. So the economic data, I think, kind of took more of a front stage to the tariff headlines compared to previous weeks. We had a series of what I'd call tier one economic data, mostly focused on the labor market. So we got a kind of a good update on where we stand as far as it relates to the condition of the labor market. Just kind of to walk through chronologically of the economic data releases for the week. We started the week with Tuesday with kind of key economic data. We had the JOLTS job openings data. That did come in lower than expected. You had the number of job openings falling to just under 7.2 million. That was kind of well below what the market was expecting. They were expecting around 7.5 million. So this data is a bit lagged as of March. So it is a signal that, at least as far as March goes, the demand for labor has softened. Um, and if you look at the jobs opening rate at 4.3%, that was the lowest since June 2020. Another way I like to look at this JOLTS data is just comparing the number of job openings to the total number of unemployed, to get a sense of the labor supply demand dynamic. And that has come back in a much better balance. They're essentially right on top of each other with a ratio of one. So that does signal that we are seeing continued normalization in the labor market, the tightness in the labor market that we experienced in 2022, which led to kind of, a precipitous rise in wage growth that has come down. So that is a good signal for normalizing wage growth going forward. That was my key takeaway from the JOLTS data. We also got consumer confidence. As we've discussed on this call in the past, consumer sentiment has deteriorated, and we did see that with the conference board estimate of consumer confidence. It was really driven by deterioration expectations as consumers are pretty fearful about the impacts from tariffs. We also on Wednesday got our first read for Q1 GDP, which showed that the economy actually contracted 30 basis points Q over Q annualized in the first quarter. But this was largely driven by a 41% rise in imports. That fed into net exports detracting 4.8% from that headline number. So the negative number was really just driven by this rise in imports, which was, obviously coming from, folks front running the tariffs and, getting their imports in before those tariffs hit the market. If you look at consumption growth, while it did downshift from the previous quarter, you're still getting a 1.8% consumption growth. And you also saw a pretty significant rise in private fixed investment, which was up 7.8% after accounting for rises in inventories. So what I'd call your core real GDP, which is basically just limiting it to your consumption and investment, which is more of like the cyclical components. It says pretty strong read on the economy for Q1. You really got to take out those volatile export
I,
components.
I think you make a good point there, Ryan. And one thing that I've been reading about that obviously every economist is thinking about as well is how, the net imports was a huge drag, but then those net imports become inventories or investment, right? And so, like, there could be sort of a knock-on effect going forward for the next quarter's GDP once all of those imports get shaken out, or that they're just going to be consumption if consumers buy things. So I don't know. It is a really it was a shocking kind of situation with that huge front run of the tariffs, but I don't think the story is written on what that impact really is going to be yet. What do you think?
Definitely. That's why I try and strip out those volatile components. So, you're right. When net exports or when you see a very large increase in imports, that tends to feed into inventory builds, which is a positive contributor for GDP. But then that, high levels of inventories can lead to drawdowns in inventories in the following quarter. So that could be a negative or a headwind for GDP in Q2. That's why I like to strip out inventories and net exports with that CNI. And that was actually showing 2%. So we'll have to see. It's really going to come down to consumption. And we got some pretty strong labor market data this morning. So no real significant signs of deterioration in the hard consumption data yet, but the verdict is still out. On Wednesday, we also got an update on the inflation front with personal consumption expenditures, the price index. Pretty positive report, and one that the Fed would like to see. You saw both flat month-over-month growth in the headline and core PCE data, which brought the year-over-year headline reading to 2.3%. That was for headline. And then the core, that decelerated down to 2.6, which kind of matched the low we saw earlier in the quarter. So that was a pretty good read on inflation. Obviously, this is going to be negatively impacted by the tariffs coming down the line. So, a lot of uncertainty on the inflation front, but before the tariffs hit the economy, I'd say the inflation dynamic was one of, decelerating inflation, moving slowly back towards the Fed's, 2% target. But again, a lot of unknowns right now in the upcoming months, just with how much of the higher import prices are going to feed through into that that core goods component. We also got on Thursday initial jobless claims. We like this just because it's a high frequency weekly reading. Kind of interesting though. The initial jobless claims number did tick up 18,000 to 241. Um, there tends to be some volatility around the spring break period. So we'll have to wait and see how this plays out over the next couple weeks. And we also saw continuing claims increase 83K to 1 point, just over 1.9 million, which was the highest level for continuing claims going back to November 21, which I think got a lot of market participants thinking we might see a weakish payrolls report this morning, but um, that did not come to fruition, which I'll get into later. On Thursday, we also had the ISM manufacturing PMIs, which, dipped further into contraction territory at 48.7, slightly better than consensus estimates. The underlying components were weak, saw both new orders and employment in contraction. And yeah, unfortunately, the prices paid component edged higher to a, multi-year high, signaling that manufacturers are seeing higher input prices. So it's yet to be seen how that will feed through into the official inflation data. Then this morning, I think the most important, data release of the week, we had the April non-farm payrolls report. And I'd say just from a high level, the April report was a pretty, constructive read on the labor market. If you look through the underlying details, they generally improved. The headline number from the establishment survey showed 177,000 jobs are added during the month. That was above the consensus of 138K. Um, there were some downward revisions to the previous 2 months of 58,000. So when you detract the downward revisions, from that headline number, you kind of get back to where the consensus was thinking. Private sector, they added 167,000 jobs during the month. That brought the 3-month moving average for the private payrolls up to 148K. It's kind of back in line with like your pre-COVID run rates. On the household survey, the unemployment remained unchanged at 4.2%. Saw the participation rate edge up to 62.6%. So that was both positive, and if you look at, like, kind of the different age components of the participation rate, kind of a broad-based improvement there. Um, Wage growth, that actually decelerated, saw the month-over-month increase of average hourly earnings up only 17 basis points, so nice to see a bit of a deceleration there. That's a positive feed through to kinda like forward-looking inflation. That brought the year-over-year, growth rate to 3.8%, unchanged from the previous month. And one indicator I like to look at just to get a read on, like, how consumption might be impacted over the near term is the aggregate labor income, which is the product of the number of jobs added times the number of hours worked per week times the average hourly earnings. And that actually we saw an acceleration there. Saw 3-month annualized change go up to 6.4% and the 12-month rate edge up to 5.3%. So kind of a strong read on labor income, which, as I said before, is kind of an indicator that, is it's a positive impulse for consumption, at least over the near term. And, obviously this data can change on a dime. But that being said, so far the deterioration we've seen in the economic data has been mostly on the soft data, your surveys and your sentiment data. You're not really seeing a significant retrenchment in the hard data, and that's really what we're waiting to see. And that's what you need to be into it, an official recession.
And I think that's a good point. I think that's a good point, Ryan. Like, I think people are stressed out. I think all the economic volatility, the political sea change, the uncertainty regarding tariffs has given people anxiety. And you see that in the soft data. Now, the there hasn't been massive damage to the real economy yet, as we've seen in the hard data. So I think that's something that investors have to observe is this kind of continued strength in the US economy, but there are headwinds because the tariff negotiations are still happening and we're still waiting for legislation to come out of Washington. So all in all, I think you nailed it. You have this fear um, in the soft data, but the underlying economy is still moving forward.
That's right. That's right, for sure.
Anything else to really highlight this week from an economic standpoint?
No, that's really it. We can get into the week ahead if you want me to cover that. It's
I
pretty
mean, it's going to be a pretty light week.
That's right, for sure, especially compared to this week. On Monday, got ISM services. That data's for April. Not a whole lot as expected, not much of a change from the but then we got the FOMC. The FOMC on Wednesday. Normally that'd be a pretty important meeting and event for the markets, but not a lot is expected. They're expected, the Fed is supposed to expected to keep rates on hold. Looking at, just the problem.
Market is to that point. I mean, the market's pricing in a whopping 3% chance of a cut at the meeting. That's a real barn burner there. I guess I guess that realistically, everybody's gonna be watching Jay Powell and see how he tap dances around the numerous questions that he's gonna get regarding his job, right?
Yeah. Yep, it's gonna be, I'd say, challenging for Jay Powell, and the market's just gonna really kinda hold on to how he's guiding the market as far as expectations go for the upcoming meetings. Just based on what we've heard from other Fed governors, it seems like they're in this kinda wait and see approach, and which has played out so far pretty well. I think they're really going to need to see some deterioration in the real hard economic data before they really start to consider, further rate cuts. Um, Perhaps also, maybe renewed bouts of volatility in the financial markets. But that's really it for next week.
All right, well, that was a pretty interesting month, I will say, and that kind of wraps it up for the week here on Double Line Minutes. Hopefully, all our investors out there are finding a little bit of tranquility amidst these changing times, and thanks to all you listeners.
Yes, thank you all to our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. We have a lot of interesting content out there, and I think we're going to be posting some more next week after Fed Week.
Take care, everyone. Thank you.